Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me, it's at finding_finance, or you can join our community and/or that's where I dive deeper into all these sectors, looking for potential investment opportunities, answering your guys' questions during the Q&A sessions during the weekend. We generally have that either Saturday or Sunday at different times to capture everyone in the world. And we have a special coupon code going on. Special is the coupon code. If you'd like to join and try it out, you can get a discount doing that. So coming on down, we've got investing.com. Where are we now? I'm going to take it a step further. This is the cycle. This is bottom of the cycle. So I think that we are in the mania phase, starting to come back down in denial/bull trap. We're probably somewhere over there. The beginning of this cycle bottomed in 2009, and we've peaked in 2024, 2025. We've been kind of rounding over in the new paradigm. That's when crypto, Bitcoin, Ethereum, altcoins, everything was ripping. A lot of intangible assets were doing quite well. And I think that's all in this greed, delusion, new paradigm phase. I do think that we're going to roll over, which has started in the denial bull trap. That's kind of what is next. And then it's going to suck people in this bull trap in a, quote, return to normal. Now, if we take a bigger picture view, we back out for the S&P 500. This is the cycle that we look for. Commodity bull cycles from 29 to 50. It broke out of that consolidation. We had another commodity bull from 69 to 1982. It bottomed in 1974 if you had the cojones to get in there. 2000 to 2009. 2009 was this bottom here. If you bought the bottom of 2009 in stocks, you did absolutely wonderfully. And you could have chose a wide variety of companies. You didn't even need to push the leverage all that hard. A lot of companies did incredibly well from 09 to 2024. And then I got the fractal here. I think we are peaking in 24, 25. I got the fractal from this 69 to 1982, this guy here, and I overlaid it on what I think is potentially an outcome or path. Am I going to be right? I don't know. I'm just telling you guys that it's similar. When I put it up here, it's very similar in what this could potentially look like, and the path that we could potentially take. So something on the lines of that will probably break out at 2030 something. It'll bottom in 2031. That makes sense to me. We probably might have a potential pullback here in the short term. Maybe we bottom in 25, 26, and then we pull back up and commodities will outperform. It will be glorious for the commodity bull market. Now, when this thing pulls back, gold and silver generally outperform. Gold being the most reliable outperformance. If this comes in bottoms and comes back up, sometimes oil likes to turn somewhere in the middle here. So I think that commodities are the spot to be. It's obviously cheap compared to financial assets, and I think this is what it's going to look like playing forward for the S&P 500, unfortunately. And that deals with overvaluations. It's overvalued. And then you get this chop sideways during a commodity bull market. So that's where I think we're at. That's the big cycle view. This is the other cycle. The other cycle was 09. So it started here and ended here. And valuations were pretty favorable down here. Commodities were expensive. S&P 500 was cheap. And we ran it all the way up. So that's the cycle. And then gold's going to outperform, silver's going to outperform. There's going to be a lot of outperformance of precious metals and commodities. Closer to the bottom than we think. This is bullish trend insider buying. Dwayne Giggs of Canadian Natural Resources. I'm just sharing this because we are seeing massive buying pressure by insiders in oil companies, specifically up in Canada. I'm talking massive insider buys. Maybe not this one in particular. 51,000 is not that big, but I'm seeing many, many, many millions of dollars being deployed by insiders, specifically in oil and natural gas companies in Canada. Many, probably tens to hundreds of millions of dollars being deployed across all of the companies. And insiders, I mean, some people will say, oh, it's no big deal. It's an insider. Why does that matter? Because when insiders buy, they have confidence in the company that they're buying because they have insider information. They know their company quite well, and they don't buy it to lose money. So they buy it to make money. They think it's cheap. They think it's undervalued. They think it's going to go up. And this is the only sector that I see this amount of buying going on. I mean, it is ridiculous in terms of how much they're buying in relationship to the market caps. I mean, I'm seeing, 2, 3, 4, 5, 6, 7, 8 million in deployment of money in a market cap company that may only be 300 million in market cap. I mean, that's pretty good buy-in there. This is Disney World crowds today. Recession canceled. That is pretty busy, guys. Now, I don't. A recession is just a small move in gross domestic product. So you could still look. It could still be busy at some of these areas, and we could still be in a slowdown. But across the nation, and the things that I'm seeing, people are spending money, man. They are spending money, is what I see. I don't see people hurting too much. I don't know anyone personally that's hurting too bad. So I think it's stronger than what most think. Silent Depression point 8 says in the past 25 years, the average purchasing power of the average American wages have fallen by 50% on a per capita basis. Your wages, even though they may increase in nominal terms, are losing about 7% per year on a compounded annual growth rate basis. And what he's got charted here is personal income divided by the M2 money supply, and it's the percent change. So personal income per capita is the red. M2 money supply. So you can see this is declining rapidly from 1999 onward. Pretty strong decline in personal income when adjusted for the M2 money supply. So think of this as your personal income divided by the real rate of inflation. That's pretty much what it is. Jordan says gold is at all-time high breakout analog. This chart plots the 4 historical breakouts to new all-time highs that were sustained on the current breakouts scale. Gold is currently trading very closely with both averages. So he's got a bunch of gold bull markets positioned here. He's got the blue, which is 72 breakout. There's a black one there, 1978, which I think is somewhere here. We've got 2009, which is in the red. And then we've got the 2024 breakout. I know it's kind of hard to see, but it actually is right here. And then he's got the average 1 that comes up, and then the average 2 from where we're at coming on up. So we still have a ways to go if they were to follow some of these averages that he has in there. Average 1, we would probably get to, I don't know, it looks like $6,000 an ounce, which is right where my mouse is. And then the other one would probably be, I don't know, looks like 4,250, 4,500, something on the lines of that. Is probably where we could potentially end up, maybe in this next, straight move higher. Martin says, markets are going to rip Monday. 23% of all Chinese imports coming to the U.S. are now exempt from reciprocal tariffs. This is a massive U-turn in tariff policy. And over the Q&A session, I was talking about these tariffs and who knows if these things are going to stay, if they're going to be removed, lifted. No one knows. And here we are getting some more information about some of these tariffs being exempted or removed. And this is, let's put tariff exemptions into perspective. The U.S. imports approximately 100 billion of computers, smartphones, and chip-making equipment from China per year. A total of 439 billion of goods were imported from China into the U.S. in 2024. This means 23% of all Chinese imports coming into the U.S. are now exempt from reciprocal tariffs. This is a massive U-turn in tariff policy is what's going on here. Value theory, posting up a quote from Warren Buffett, says most people get interested when everyone else is. The time to be interested is when no one else is. You can't buy what is popular and do well. So what was very popular, at least to me, these are the popular areas. AI, NVIDIA, which is semiconductors, and crypto. Those are all the popular areas. The non-popular areas are anything commodity or energy related. Those are definitely not popular. So when I was at the store, we've got a grocery store right next to me. I was in there and I was just overhearing a couple of conversations. Over the past, I'd say 3 or 4 months, I've heard 2 conversations. One talking specifically about NVIDIA and how much money they made. The other one was talking about crypto, Bitcoin specifically. QE Infinity, serious question. Is there a chance we just scrap the whole tariff plan? There is a chance that the whole tariff plan could be scrapped. What would that do to the market? And are you positioned for that potential outcome? Everyone is so bearish on the tariffs being put into place, but maybe someone should question, are they even going to go through with it? And then what is the market pricing? Are they pricing a tariff plan not going through, or are they pricing a tariff going through? I think it's being priced with the tariff going through, and some of it's been peeled back a little bit. And that's what the market's kind of figuring out. I have no idea if they're going to scrap this whole thing or not. I have no idea if they're going to keep in place. No one even knows what the heck the amounts are going to be if they do stay. Talk about ambiguity and uncertainty. Charlie Munger says, extreme patience combined with extreme decisiveness. You may call that our investment process. Yes, it's that simple. Break it down. What is extreme patience? Why do you need it? And what is extreme decisiveness? You guys have heard this quote before. What is that? What does it mean? Well, what it means is that they are taking a long-term time frame, extreme patience, and they're taking advantage of a short-term market dislocation, which requires extreme decisiveness. So what they're doing is they've got a watch list of companies that they know are good, they know what the values are, and they wait patiently for a market opportunity to present itself where maybe fear enters the market like we just had not too long ago. And they find out, they watch their companies, they find a good entry point that is beaten down because of fear, and then they use that decision, the extreme decisiveness, to take a big position when everyone else is fearful. That's what extreme patience. You need extreme patience on the front end for the opportunity to develop. You need extreme patience on the back end after you buy it to let the fear leak out of the market and a better and new market condition to come in and reprice your assets higher. And they need extreme decisiveness because the window of opportunity isn't going to be open for very long. So they have the patience to wait for the opportunity. They've got the extreme decisiveness when the opportunity presents itself to not balk at the decision. They just say, you know what? I'm getting in there. I'm going to get in big. Bam. Give me the shares. So it's that combination that is successful, at least for them. The U.S. federal deficit says unsustainable, and we're running these big deficits. The 0 trillion mark is up at the top there, and we are blowing out. The area under the curve is the big deficits that we've been accumulating. Now, what does unsustainable mean? What is that outcome? What does that mean to the average person? So the way that I view unsustainable is that we are going to experience rapid inflation, big inflation numbers like 10%, 14% inflation is what I read as unsustainable. And what that does is it hollows out your economy, it hollows out the value of your dollar, and then people need to go running into hard assets and other things to preserve their wealth. So that's what unsustainable means. And eventually, and I don't know when, it means that the currency will probably go to zero. That's what unsustainable means. We've got, and this is Jeffrey Gunlock. He says, halfway through fiscal year 2025, the U.S. budget deficit increased by 1.3 trillion. So we are up to a 2.6 trillion annual rate. That rounds up to an incredible 9% of GDP. The fit is hitting the shan. So the SHIT is hitting the fan. And we're spending a whole bunch to keep this wheel moving, to keep this this whole system surviving. Kevin Bambro, he's putting a lot of stuff out, a lot of good stuff. A story that centers on you becoming rich is it should be exponentially more seductive than the truth that you're conned into a Ponzi scheme. Understand this fact, and you will understand the single most important reason why crypto coins are attracting capital. Now watch how many bots reply to me in the comments section. So a story that centers around becoming rich is exponentially more seductive than the truth that you're conned into a Ponzi scheme. Coming down, Peter Lynch, he says, people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. And that's a big deal. You got to stay in the game to win at the game. And you can't be scared out of it. And these calamitous drops, or the big drops, they're going to occur from time to time. The difficult part, I think, for most people is to get that confidence. The confidence that they've got the right company in the right sector, the confidence that they can hold on and they know and understand the companies, the confidence of what is to come. Why are they holding it? What's coming? They have a strategy. They see a vision. And that's, I provide a lot of that on the website, I think. And then people understand the strategy. They understand portfolio allocation. They understand asymmetry. Maybe diversifying across many sectors, which all have asymmetry, and you don't have to win all at once. Different market conditions will impact different sectors at different times. If something were to come, it's not coming out of left field. You expect that these things are going to occur. You can get big pullbacks or drops in the market. And that you should be taking advantage of those drops instead of selling into fear. You should be buying fear. It's all a game, guys, and it's all psychological. And what's even worse is I think some of these pullbacks are done on purpose, and they know what the normal individual will do. They know it's going to scare you. They know they want you to sell. They create volume for bigger buyers coming behind you, potentially, to buy up whatever stock there is at lows. So they scare you out of your shares, they steal your shares, and then they hope that you buy back later to push the stock price higher after they have purchased. You're just a little sheep or guinea pig or whatever you want to call it, going back and forth between FOMO and fear. You got to control your emotions in this game. You got to let the game teach you the game. Douglas says, we will tariff China on everything but 99% of what we import. Trump exempts phones, computers, chips from new tariffs. Kind of interesting how this is flip-flopping back and forth. We could see a big up day on Monday. That is a very big possibility with these tariffs being moved around. News is coming out all the time, getting these big moves in the markets. It's crazy. It's crazy. Mohammed says below and attached from the FT article, liquidity worsens in the 29 trillion Treasury market as volatility soars. So liquidity is worsening for the Treasury market. Analysts at JP Morgan said market depth, a measure of the measure of the market's ability to absorb large trades without significant shifts in price, had significantly worsened this week, meaning even small trades were moving yields significantly. In here, it says, we are concerned because the movements you see point to something else rather than a normal sell-off, said European bank executive in Prime Services, a division that facilitates leverage trading for firms including proprietary traders and hedge funds. They point to a complete loss of faith in the strongest bond market in the world. And those are those big moves in interest rates that people are watching. And they're saying, I think there's something wrong when interest rates are moving 2, 3, 4, 5% a day. And that's the liquidity. So that's what's causing the big moves is the liquidity. When there isn't much liquidity, small amounts of money can move the markets in both directions quite quickly. Eric Yoon says, basically, the U.S. Treasury has to accelerate its borrowing. The reverse repo is pretty much drained. The entire world is dumping United States treasuries because of crazy tariffs. Foreign countries are recycling their USD trade surpluses into United States Treasury was the deal. That was the OG tariffs, but now the deal has changed. All of those super leveraged banksters and hedge funds, their basis trades, are beginning to unwind and break because their cost of capital is now broken. Physical gold is the only global reserve asset collateral that can be trusted. And again, this is Jeffrey Gunlock talking about the big deficits. And this here is your reverse repo chart, and it's basically almost to zero, which was providing some liquidity into the market. Here's, I believe his name's Jorge. So this is your total commercial inventory, excluding other oils. It was down 6 million barrels week over week. This is for March 19th, though. It's a little old. Implied WTI fair value of $92 or $25 undervalued from current market price, commercial inventory level. So if you look, he's got these standard deviations. And we are below a 2 standard deviation undervaluation in oil. So what he's got here is he's got the normal distribution chart. So here's normally distributed chart. And what this is you have a standard deviation, and this is, you use this for process control charts. You use this for IQ distributions, height, weight, anything you want. We are 2 standard deviations. We're in this corner over here in terms of pricing of inventory, commercial inventory levels. You know what else is priced over here? In fact, it's past the 2 standard deviations. We're probably like in this corner over here in the little tip. That's your gold to oil ratio, which is also well past 2 standard deviations. We're probably right around 3 standard deviations on that, or right at this tip. So if oil is cheap compared to inventory levels, and oil is cheap to gold, which is another measuring stick, well, what are we waiting for? Isn't it a good opportunity? And I guarantee people are going to say, oh, well, the recession, the slowdown, that's what we're waiting for. Well, is it priced in or not? If we're over here, guys, it's probably already priced in, and everyone's already bearish. I mean, how the heck did you get over here? We're not 3 sigma on the right-hand side. That's 2008. 2008 was over here. We're over here, and people are talking about shorting oil. Think about that for a second. Think about where we're located over here, and think about people trying to short that. That does not make any sense to me. Another one from Jorge says, the Permian Midland has 12 and a half years of total remaining inventory from 25,000 locations, assuming the current pace of drilling in the basin, although the pace will need to increase as per foot productivities decline further. So this is your break-even tranche. There's nothing down really below $40 a barrel. Below 50, there's a couple. Below 60, a little bit of an increase, 70, 80, and 90. And then when you get above 90, which is everything, that's your 12 and a half years. We have 10.3 years at greater than 90 a barrel, 9.3 at greater than 80, 7.5 at greater than 70, and it really drops under $60 a barrel. You're losing a lot of inventory. Bar charts says Americans now expect inflation to soar to over 6% within the next year, the highest reading in 44 years. So everyone, I guess, is expecting inflation to come. That's one of the highest readings. Pretty crazy. Lynn Alden says the crazy thing is that if you look at peak U.S. demographics and such, stocks versus gold, overall labor participation, and then qualitative happiness, that was literally the top. And they're talking about 1999 was described as being the peak of human civilization in the Matrix. And I laughed because that was obvious, because that obviously wouldn't age well. And then the next 25 years happened, and I realized that, yeah, maybe the machines had a point. Dude, 99 was awesome. I love 1999. That was probably one of my favorite years. That's when I graduated high school. I was a 1999 high school graduate, and I'm not saying that high school's the peak or the pinnacle of anything. I thought the world was pretty awesome. We had incredibly cheap gasoline in 98, 99. I can remember driving, and I think it was like $1 a gallon. Everything was cheap. It was so awesome in 98, 99, 2000. It was pretty cool. I think that was one of the best times that I can remember out there. Something broke on Liberation Day. So this is oil and interest rates. They generally move together. There's this loose correlation between the two. But if you noticed here recently, just recently, we've got a large discrepancy between the 10-year yield and the price of Brent spot crude. What's going on here? Big question mark. My guess is that oil is obviously not driving interest rates, and that maybe another outside factor is driving interest rates. Or oil is being manipulated lower, and they couldn't manipulate rates lower. Maybe. I don't know. I don't have that answer with 100% certainty. I'm just throwing out spitballing ideas. But yeah, something is definitely different here. He says, discuss Nokia and the double top there, and then the long basing pattern. And we've got Ethereum with a double top and a long basing pattern that he is projecting. Totally agree. That is your cycle of the S&P 500 versus commodities. So when commodities outperform, I think we're going to get a big basing pattern in Ethereum, just like Nokia. Yep. April 11th, Peter Brandt says the Fed is screwed. Treasury's total marketable debt is around $28 trillion, with roughly 20 to 25% maturing annually. Based on typical debt profiles, about 5.6 to 7 trillion matures in 2025. Who wants to own U.S. government 30-year debt at 4.8% yield? He says, not this old man. I agree. Who the heck wants to buy our debt? I don't want to own it at 4.8% a 30-year. I wouldn't even own a 4.8% 10-year. I don't even know if I'd own a 4.8% 2-year. I wouldn't own any of it. It's all garbage. So if I think that, how many other people think that? And who the heck are they going to roll all this debt into? It's probably going to be the Federal Reserve doing quantitative easing and doing yield curve control. That's my guess. It's probably what's going to have to come. Capital is moving into gold stocks, and it's just getting started, says Jordan Roy Byrne. Here's the breakout for GDX versus S&P and GDX versus the S&P. Both look absolutely fantastic. I can't wait for this bull market to get moving. It's already moving, but I can't wait for it to keep moving. I've got money in there, and I'll just let it go. And that's all I've got for today, guys. So that's where we're going to end it. Give me a thumb up for the content. subscribe to the channel, subscribe to the website if you'd like. Use that special coupon code. I've already uploaded all of the Q&A sessions. This last one that we just did, it's all uploaded. It's on the website. It's ready to go, and we'll see you guys next time. Catch you later.